Seth, hi, morning. Fed says considering, or rather Trump says considering a rate hike by the Fed is going to be incredible. But what do you think they'll do?
Well, I believe the Fed is on its way to raising rates. It's the last meeting of the year, and we are seeing some slower growth, of course, but I actually think we're going to see one last increase.
Said the fact that Fed was supposed to move is yesterday's story. Why are markets nervous ahead of the Fed meeting, and what explains this kind of a gut-wrenching fall in S&P, Nasdaq and Dow? I mean, the kind of selling what we've seen and the reversal what we've seen in the bond yield, it looks like financial markets or US financial markets are warning us, they are telling us, and they're indicating that a big recession is coming in 2019.
Well, one of the problems is we're getting to the end of the year, and investors are likely to take more defensive positions and be more defensive in general. But we're certainly seeing, a huge sell-off now. It seemed like maybe it was just going to be more gradual 2 or 3 weeks ago. But we're seeing these consistent drops. We're seeing so much uncertainty involving, such a wide range of issues. We have potential partial government shutdown. We have uncertainty about Obamacare and health benefits, and oil prices beginning to go down, which one would think is positive. So it's a lot of different messages all at once.
Right. How much more downside would you give to the U.S. markets? Is this just a course correction, or do you think that this can snowball into what may lead to the start of a bear market?
Well, I think we might have hit a bear market. So I think we're probably there now. It really just depends, I think, on global factors, what's going to happen. We thought we were going to have a little bit of relief from the impact of the trade war, the tariffs and so forth, but it's not seeming to have that effect. So unfortunately, and it affects all consumers as well who have a lot of wealth tied up in the stock market. I think we're going to continue seeing a basic downdraft. One of the other issues as we get into the holidays, volumes go down. So what would ordinarily be, relatively small changes in pricing in markets tend to be exaggerated because of low volumes.
Okay. Seth, we saw a similar factor, I think, way back in 2007 or 8 when US markets they started correcting. Emerging market watchers, they said, guys, fall in US markets is good news for emerging markets like India. They offer better growth and there would be decoupling. And the decoupling played out for next 6 months, whereas US markets kept on going down because of subprime concerns, and emerging markets like India, they kept on going higher. So will history repeat itself in the first half of 2019, where US markets will remain low, emerging markets will outperform, and India will outshine?
I think this time conditions are quite different than 2006, 2007. I remember that distinctly. And what's very different now is over the last 10 or 11 years, we've had a huge growth in ETFs and other index-based products. And so there's a little bit more synchronous movement because it's all about allocations across indices as opposed to enormous amounts of stock picking like we saw back then. So I think the conditions will be slightly different. I actually think that what might happen defensively is investors, both institutional investors and private investors, are going to end up taking some money off the table.
Right, Seth, we'll leave it at that. Thanks very much for taking out the time to speak with us this morning and making sense of the U.S. markets and the performance.
Thank you.